Like YouTube. It's gonna hit you from even if you don't want to have one.
Name of the channel.
We're live on YouTube. But Kimmy, you gotta figure out how to record this now.
In the top corner here.
Your default has changed to speaker, Jetty stereo microphone, that's fine. Now here.
And here. Or maybe it is down here and then you can hit record from there. Yeah, record on the clock.
Job, John.
You're all set? I move it back just a bit. So, do I need to push anything or are we just gonna take off? We're live,
Oh,
live?
thanks so much.
Okay,
That's perfect.
Thank you.
Thank you.
all right, well, we are live now, finally. Oh, the camera's up here. I'm used to looking down here. Thanks. Right, so my name is Ron Donovan. I'm a realtor with Keller Williams out of Geneva, and you are at the Real Estate Experience Live. Today, we are coming to you from Burrito Los Asaderos y Mariscos in St. Charles. How'd I do?
Pretty good.
Yeah, not
Pretty
bad,
good.
right? Seventh grade.
Even rolled the R a little bit. I
little
liked
bit.
it.
Thank you, Bethany. So joining me today is Bethany. Bethany Bialis is from Apex CPA and Consulting. So Bethany, what are you bringing? Why did we choose you to come talk about tax and entities today?
Well, I get excited about all things tax and accounting, I guess. So I'm probably a good pick to talk a little bit about entity selection and just kind of tax law in general. So I'm really excited to be here. Apex was founded in 1998. So we've been in the Fox Valley area for a very long time. I've been with the firm for several years and have a long history in public accounting and tax. So happy to help.
Awesome.
Thanks for having
being
me.
here. No, we're glad you're here. We need help with this. Absolutely. So
Well, I'll do my best.
for the vast majority of realtors, real estate agents, we are considered independent contractors. We're our own business. So there's a variety of methods we can use to form that business. What are the four basic types of corporations or entities that we can use?
Yeah, so that's a really good point. Entity selection definitely is a really important consideration when you're kind of trying to figure out what the best methodology is for you to do business. There's a lot of different perspectives and reasons why a person might choose one or the other. And just to kind of go back to what are those different options, we've got S corporations, C corporations, we have LLCs or partnerships.
Mhm.
And then, of course, there's a sole proprietorship, which is basically more of like a doing business as it's the tax filing is done on your personal tax return. So that's probably the more common or more casual option of the four.
Okay, maybe start with that one then. So sole proprietorship, what would be the advantages? To that, and then tell us some disadvantages.
Okay, sure. So yeah, when you think about what kind of entity you want to be classified as, it's really important to look at several different perspectives. You'll hear, of course, as a tax professional, as a CPA, I'm probably going to focus more on the tax considerations, but there's also legal considerations. There is also managerial or operational considerations. So I'll try to keep it fairly high level. A sole proprietorship is, it's a single owner. So that's just going to be you're kind of owning your business on your own. You're in charge. You don't necessarily have a partner or shareholders or a board of directors that you're responsible for, that you have to answer to. Sole proprietorship is definitely the easiest of the choices. It's the easiest to form.
Okay.
You just can kind of wake up one day and say, I am a sole proprietorship. There's not a lot of state filings typically. Most of everything I'm talking about in terms of states would be for the state of Illinois, of course. But you don't really have to like register or do anything like that. So when you are a sole proprietorship, one of the main things that we think about is liability. When we talk about, what entity should I be? How should I classify my business? With liability as a sole proprietorship, you don't have any separate business entity. So the liability considerations could be greater just because your personal assets and your personal liabilities are not separated from those, of your quote business. So, I'm not a lawyer certainly, but it's always something that you should be considering is what are the legal ramifications of whatever entity classification that you choose. You do have, as a sole proprietorship, you'll have basically unlimited personal liability. So if something were to happen, you could be personally liable for it. So that's certainly a consideration. I did allude to it earlier, but from a tax perspective, sole proprietorship is probably the most simplistic in nature. Again, you're not setting up a separate business entity, so you don't have a separate tax return that you have to file. But that does mean that generally speaking, all of your earnings, all your net profits are going to be subject to self-employment tax.
Okay.
So that can be kind of a downside. You don't have any really flexibility there to shield any of your earnings from self-employment taxes. So that's certainly something that you want to consider as a sole proprietorship.
So to kind of wrap up, easy to form,
Easy to form,
kind of
agreed.
easy to administer, so to
Mhm.
speak, but riskier as far as the legal side
Right.
of, and less tax benefits than the others.
Right, yeah, I would say less tax benefits. You certainly have less opportunity to kind of structure or plan your taxes. It's pretty straightforward.
Okay.
Everything you earn is going to be taxed for both income tax purposes and self-employment or payroll taxes.
Got it.
Yeah.
Well, let's go from, we'd say that's the basic, right? That's the.
I think that's the basic.
What's
Yep.
the next? Let's go to up a level.
Okay, up a level. So up a step is what's called, it's kind of a subset, I guess, of one we touched on earlier is the LLC, which is a limited liability company. And a limited liability company is really a legal classification. Typically, when you think about an LLC, it's going to be a multiple person ownership. So it'd be, you and I go into business together, we set up an LLC. However, there is something called a single member LLC that could be owned by just one person.
Okay.
So the idea with that single member LLC is that it would be taxed similarly to how we just spoke about that sole proprietorship idea. But you have a little bit of liability coverage where if you were simply a sole proprietor, you hadn't registered as a business or set up any kind of legal entity per se,
Okay.
you wouldn't have any possible liability coverage. So a lot of times we will see that people might set up a single member LLC. They'll still operate as a sole proprietorship, but they do have a little bit of kind of separation, I guess, by setting up that LLC. So that's something to consider, certainly.
Okay,
But
so-
from a tax perspective, no different than the sole
Really? So-
proprietorship.
Okay. And then as far as how tough is it to set oneself up as a sole proprietor LLC? Any idea?
Dangerously easy, I would say. I mean, it kind of depends, there's levels of complexity. So, you can set up a single member LLC, you can pop onto the internet and go to LegalZoom or wherever, there's plenty of websites out there that'll volunteer to help you for a fee, set up an entity with the state.
Okay.
Legal entities like LLCs are typically, like there's state registrations that you have to do. So again, this is kind of talking about Illinois, but it's really just a matter of filling out some forms, paying some fees, and here's your LLC.
Okay.
Now you can certainly get much more complexity if we're talking about a multi-member LLC. That gets into, okay, well, who are the owners and what is the ownership structure? What are the ownership percentages?
Mm.
You've got operating agreements where you can consider profit and loss allocations. So it can definitely kind of run the gamut of very, very simple all the way up to very, very complex.
Oh, wow. For not a lot of tax benefits, you said, and marginally
Right.
not a whole lot of risk benefits.
Right.
So maybe not the best choice.
Yeah, I mean, definitely a single member LLC. Again, it has its benefits from a liability perspective. It's not going to have really much benefit from a tax perspective. Now, when you kind of move on from single member and you start talking about a multi-member, that's where as a two-person LLC, you would actually have a separate tax filing. So you would be filing as a partnership, which is an extra, obviously administrative, expense. Instead of filing your normal personal 1040, you'll file that plus a 1065, which is an additional tax return. So all of the LLC income would get reported on the partnership tax return. Now, I will, the tax person in me has to say there's other elections you can make to be taxed differently as an LLC, but I'm just kind of talking about in generalizations here. So once you get into like a partnership filing, you do get a little bit more complexity and a little bit more tax opportunities, I guess, because now you're a separate taxable entity. And you have kind of some opportunities as that to determine, okay, am I going to pay my members as a guaranteed payment? Are we going to do tax distributions? There's a lot more kind of options and opportunities that you have when you're set up as a partnership. But hey, having said that, as a partnership, you have to be a partnership. So you have to be with another individual, at least one, that you'd like to do business with. And, that brings up questions of flexibility, in your business model. What can you change? What can you, if you're doing business operations ABC today, and in 5 years, you want to change that. It's a lot easier to do that as a sole proprietorship than it is as a partnership or an LLC. So flexibility, control, of course, is another one that's like a very important one to think about. As a realtor, like you don't necessarily want to find some partner just so that you can be set up as a partnership. So not necessarily the best choice, at least in this industry, depending on what your kind of goals are.
Okay, that makes sense. Okay, well, let's go one more step.
Okay.
Move up to the next.
We can do that.
Okay, thanks.
Okay, so I guess next kind of natural segue would be to go to the partnership. So we did talk about the LLC a little bit. I think the biggest thing to keep in mind with that LLC is that it's really more talking about the legal protection that the entity structure as LLC provides. Partnership is really more of like a tax verbiage, I guess. And like I mentioned earlier, that would be filing a form 1065, which is a separate tax return. Now, one thing I'll say that applies to a 1065 as well as an S corporation, which is what we'll talk about in a few minutes. These are both what we call pass-through entities. And what that basically means is you have a tax return that's filed by the business, but the actual taxes themselves pass out or pass through to the owner. So rather than paying the tax at the entity level, it will still come out to the owner on a K-1, and then you would pay the tax as the owner. So it's kind of an interesting concept just because the taxes take place, like I said, at the entity or at the personal level, but you still have to file a tax return for the business. So something to kind of keep in mind that I think a lot of people don't always realize when they're considering, well, do I want to be this or do I want to be that? Is the administrative aspect of it. As a sole proprietorship, you just be a sole proprietor and you do your job and then you file your tax return the same as you would as an individual. Once you start getting into these other ideas, you're filing a 1065 or an S corporation, you have to not only file that other tax return, but then you have to file your tax return, and having that K-1 that comes out makes for more complexity. So a little bit harder to file your tax return, probably not, you could do it on TurboTax. I don't know that I'd recommend it. So you've got that administrative aspect from a tax perspective, but you also have ongoing filings that you have to take care of through the state of Illinois. There can be other legal considerations. So just want to point that out as well.
Okay, interesting. And is that, just so I'm clear, that was the partnership LLC that we went to? You just
right.
Okay,
Yep. Partnership LLC. So a partnership doesn't necessarily have to be an LLC. It can be an LLC. You can have a general partnership. You can have a limited partnership. You could have a limited liability partnership. There's lots of different classifications, but as I said, it is a pass-through entity. So the actual tax repercussions take place on the owners, whether it's, the partner's tax return or the member's tax return. I would say a partnership, generally speaking, is the simplest structure if you have two or more people and you want to own a business together. It's fairly easy to form. It's pretty flexible. One thing we'll talk about when we get to S corporations or C corporations, there can be a lot more limitations in terms of what you can or can't do, either from a legal perspective or from a tax IRS perspective, versus with a partnership, you can be very flexible, maybe a little creative. If you and I said, hey, let's get into business together and, you're going to contribute 100,000, but I'm short on cash, so I'm not going to put anything in today. So from a capital perspective, you're the 100% owner. But maybe I'm doing more work in the business. And so we want to split the profits or the losses 50-50.
Mhm.
That's something that we have the opportunity to kind of create for ourselves and figure out within our partnership agreement how we want that to work. So definitely flexibility from a partnership is one of the pros for sure.
Okay, well, I think that was a good segue to S Corp, no?
S corps, yes. Before we go to S corps, I will say one thing real quick on partnerships. Similar to what we spoke about with sole proprietorships, when it comes to the way that the actual net profits are taxed as a partnership, generally speaking, again, assuming that we're talking about an individual or individuals engaged in a realtor type business, all those the income from the partnership is also going to be subject to self-employment tax. So again, kind of going back to our buckets, we had the sole proprietorship, 100% of your net profits are subject to self-employment tax. Partnership, still subject to self-employment tax, regardless of kind of how you structure it. So something important to keep in mind there. And that's, similar to if you're a wage earner, you've got your payroll taxes, your social security, your Medicare that you pay that comes out of your paycheck.
Mhm.
That's basically the equivalent of a self-employment tax.
Got it.
Okay, so then if we move on to S corporations, this is kind of like a subset of a corporation. From the state or legal perspective, when you go to the Illinois Secretary of State and you want to set up a corporation, it's very similar. Like when you set it up, whether you're an S corp or a C corp, you just set up the corporation with the state of Illinois. An S election is a tax item. So you're still a corporation from the perspective of the Secretary of State, but for tax purposes with the IRS, you've made an election to be treated as an S corporation. And this is very important because an S corporation is classified as a pass-through entity, which we talked about earlier, where the tax return and the net income, the profits are calculated at the entity level, but the tax impact where you actually pay the taxes is on the individual level. So that's kind of what an S corporation is. Now, the nice thing about the S corporation is it creates a separate entity. So from a liability perspective, you don't have that same openness as you did with a sole proprietorship, where your personal and your business assets are just kind of mixed and all together. You don't have personal liability, generally speaking, with an S corporation or a corporation in general, I should say. So an S corporation, like I said, it is a pass-through entity. So the taxes are assessed at the individual level. But what's nice about an S corporation, and I want to kind of touch on this without getting too technical in terms of taxes. An S corporation is a pass-through entity where the income tax is paid at the individual level. But the key difference between an S corporation and a partnership is when we talk about self-employment tax. Okay, so if we take an example and we say, you have $100,000 in net income. So you brought in however much money, you had some expenses, your net income is $100,000. If you're a sole proprietorship or a partnership, simplistically, that whole 100,000 is going to be subject to about 15.3% or so of self-employment tax. As an S corporation, you do not entirely have to subject your net profits to self-employment tax. And the reason for that is that as an S corporation owner, as a shareholder, you're considered to be an employee of the S corporation. So what happens mechanically is that you actually take a wage from the S corporation. So you may be the 100% owner of an S corp because you can actually own it on your own. You don't have to have another partner or shareholder or anything. But you do. So going back to the $100,000 example, what would happen is you as the employee and also the shareholder, so you own it, but you're also an employee. So we would say, what's a reasonable amount of compensation that the S corporation can pay to you in your position, in your role? So, if we use maybe an example of a lawyer, you're an S corporation and your business is to be a lawyer. What is a reasonable amount that the S corporation could pay you to do your lawyer services? So if you say $10,000, probably not the case. I don't know too many lawyers that are going to work for a year for $10,000 for a full-time position. So you do have to be reasonable in the eyes of the IRS, but ultimately what it does is going back to that $100,000 net income example, is it allows for another deduction from your income. So whatever you determine is reasonable for the position that you are serving as employee of the corporation, you pay yourself that on a W-2. And for that portion, you get hit with the payroll taxes. But the rest of it flows out to you without any payroll tax. So of course, you're going to pay income tax on that entire amount, but at least from a payroll tax, that can be a pretty substantial savings. And that's, I would say that is the key feature about an S corporation that often makes it as attractive as it is to many people that are operating, especially on their own, where they can be 100% owner, simply because it allows us to shield some of their ultimate net income from self-employment tax. So
Any other major benefits for?
S corporation, yeah, I mean, I think that's probably the main benefit
How hard to
from an
set up?
S corp. I'm sorry, what was
How
that?
hard is it to set it up then?
Not-
You kind of been looking at that.
Yeah, I mean, not terribly more difficult than what we spoke about in terms of an LLC.
Okay.
You know, there are a couple more hoops that you have to jump through because, you know, when you go to the Secretary of State and you create this corporation, you're just a corporation. So unless you make an election to be treated as an S corp, you would be treated as a C corp. And so just to kind of pause there, I guess, C corps are probably the most common, you know, for big companies maybe, but less common when we talk about small business or, you know, individuals that maybe are taxed as independent contractors, like you mentioned. The thing about a C corp is, unlike what we've talked about thus far, a C corp is its own taxable entity. So from a liability perspective, has a lot of the same features and functionality as an S corp, you know, no personal liability, those sorts of things. But from a tax perspective, the C corporation is actually the taxable entity. So where in a partnership or an S corporation, the net income will flow out to the individual and you'll get taxed there. A C corp pays its own taxes. So currently we have a flat C corp tax rate of 21%. That came about with the Tax Cuts and Jobs Act a couple of years back. So it's a fairly attractive tax rate, considering that the highest personal tax rate at the moment is 37%. But it's a lot more structured and specific. You also are subject to double taxation. So as a C corporation, you know, you'd make that $100,000 at the C corp level, you'd be taxed 21% on it. So you pay $21,000 in taxes, but now all that money is just sitting in the C corporation. And you say, hey, I own this C corporation. I want my money. I want to take the cash out. I want to go on a vacation. Well, now when you take that money out, you're going to pay tax on it as a dividend to you. So you pay the 21% at the entity level, and then you also pay for it on the personal level when you actually take it out as a dividend. So that's, yeah, I'm sure everybody's heard, you know, the concept of double taxation. That's really kind of where that stems from. So while the 21% can be attractive, especially again, like compared to our 37%, it's less attractive when you think about the fact that you're going to get kind of taxed on it twice. And again, there's a lot of other considerations in terms of control, flexibility, those sorts of things that typically a C corporation is not going to be the best choice. So back to your original question in terms of, is an S corp easy to set up? The biggest thing I see with clients that they, I guess, mess up when they're trying to get an S corporation is they forget how important it is to file that election. Because you set up the entity with the Secretary of State, you're a corporation. You file for an employer identification number with the IRS. By default, you'll be treated as a corporation. And so it's very, very important that you file the S election so that you can be treated as an S corporation.
So what would there be any, so with double taxation, it sounds like it would be a good option if you were going to just park all those profits for the long term.
Oh, that's a good one. That's a good question. I mean, it could be certainly an option there. I will say that there is, you know, you're not the first one to come up with that idea, I guess. So there's something called an accumulated earnings tax. And basically what it is it's the IRS saying, no, we're not going to allow that. So there are limitations in terms of how much money a C corp can retain without possibly being subject to this penalty tax. You know, there's a lot of calculations that go into it in terms of like, what's a reasonable amount that a C corp would want to retain in terms of like working capital, essentially. You know, typically if you're a, you know, say you're a publicly traded company, most likely your stockholders aren't going to be very happy if you just hog all that cash and never, you know, make dividends. So it's kind of the idea behind it. And there can be some ramifications, but to some extent, yes, you would have an opportunity to hold it in there. But to be honest, at the end of the day, if when down the line, whether it's you decide that you want to be out of business or You know, from a succession planning perspective, somebody's going to have to deal with that.
Kicking the
So yeah, you're kicking the can down the road. Exactly. You're just kind of deferring the problem until a tomorrow in the future.
So do you know, have you worked with any realtors that have actually, it doesn't sound like our best, or a single person
Yeah.
company or even a small team. That doesn't sound like it makes sense.
Yeah, I mean, typically it's not. There can be isolated situations where it does, for whatever unique situation does make sense. I would say that I am not aware of any C Corp clients that we have currently that are in any kind of like personal services type industry. Not to say that it can't happen, but you also have to consider history a little bit when you think about that. So I mentioned earlier that 21% flat tax rate just came about recently.
Mm.
So prior to that, a C Corp was actually subject to bracketed tax. So just like we are at the 1040 level, you know, you can be taxed at 0% if you only made a little bit of money, or if you make a lot of money, you've got, you know, upwards of 40% rates where you can get hit. Same thing with a C Corp. So up through, you know, 5 years ago, there was a very small sweet spot where it made sense to be a C corporation because maybe you would be taxed at a lower rate. But once you got above that amount of net income, now your tax rate is high and you've got double taxation. And so, yeah, there's been a lot of history over the years, you know, as tax laws change and fluctuate, where that can certainly drive, you know, a decision about what kind of entity should we be based on today's rules.
Right.
So.
So when, we'll talk about sole proprietors and realtors in specific here, when they're trying to decide
Yep.
which one is best for me, I think they need to know their goals, right?
Mhm.
How long do they plan on being in business, and how much can they invest on the front end? And is it a part-time
Right.
job for me, or is it? So maybe take us through that advantages of, I don't think need to talk about C Corps anymore. It doesn't sound like an option, although
We
it's
can
fun.
usually table C Corps pretty quickly. But no, you make a really good point. You know, goals are really one of the biggest drivers, I think, because we can sit here and talk about the tax benefits of entity selection A or B all day. But if the entity type doesn't suit what your goal is, what you're trying to do as a business, you know, what you're trying to accomplish, well, then the tax benefits are kind of secondary to that. So I think you've hit the nail on the head, identifying what a business's goals are, what your goals are as the shareholder or the owner, or whatever you want to call yourself, are initially. That's a really good starting place. And then you can kind of go from there, you know, figure out what your goal is and if any of these choices would be a deterrent. You know, so if you say to me, hey, you know, I'm doing this business today, but I know that in 5 years, my son's going to graduate college and he's going to come join me. Well, maybe it doesn't make sense for you to operate purely as, you know, a partnership now, or, you know, with your business partner now, because maybe you wouldn't be able to change that down the line, or vice versa. Maybe it doesn't make sense for you to set up as a sole proprietorship now. So there's a lot of things in terms of your future goals. You know, are you intending to grow? Do you have a horizon in terms of how long this business is going to be operating?
Mhm.
You know, are you just starting out and you've got 30 years, or are you thinking, hey, I might want to shut this down or have some succession planning in the near future? So a lot of different considerations there. I think once you identify kind of what your goals are, then you can look at the different entity options and say, based on what I want to do, what I want to be, the level of control that I want to have, and how flexible I need it to be, then you can kind of go through the entities and say, well, this one wouldn't work for me. This one would work for me. And then from there, maybe you come to, you know, 2 choices, and you can then kind of dig in a little bit more and say, okay, what are the specific tax benefits? What are the specific liability benefits? And how do these apply to my personal situation? Because that's, I think, something people often forget to consider as well, is that when we talk about these pass-through entities that kind of flow out to your personal return from a tax perspective, at least, the result, the tax consequence of what entity you are isn't limited to just that one entity. If you have, you know, other investments or other businesses that you have on your personal return, aside from just this one, they can be impacted by, you know, this decision. So it's important to kind of take a holistic approach to it all. And yeah, honestly, I mean, you know, we have some clients that have honestly done a great job with a do-it-yourself approach. There's a lot of information out there, and a lot of it is great information, but it can be a little bit murky sometimes to navigate. So certainly we're always willing to help kind of get the T's crossed and I's dotted.
Good deal. So one of the questions we have written here is choosing the business type with the lowest tax structure always the right choice?
I think we kind of just touched on that. No, it's not necessarily the right choice. Of course, from my perspective, I'm a CPA working pretty much exclusively in tax services. So I love taxes. So I'm always going to lean on that, but it's not necessally always going to make the most sense. You know what? I will call myself a tax nerd. I'm okay with that. At this point, I've gotten comfortable with
There's
it.
not meetings or anything for that?
No, not so far, at least not that I've never found one for me.
So
But yeah, the taxes, it is a big part of it. Obviously, taxes can be hugely impactful to our lives, and there can be a big consequence if you don't consider it. So I do think it's important to consider it maybe proactively before you make a decision. But at the same time, there's a lot of other probably more important factors to your daily life than the tax setup. And I think it's at least important to visit those items before you make a decision, purely because somebody said this was the cheapest way to do it. Cheapest is not always the best.
I
So
would agree with that, Steve. Do I need to file my tax return quarterly?
ooh, quarterly tax returns. So there's a couple things. That's a little bit of a vague question. Not sure what exactly we're referencing here, but I'll kind of take it from two different
And I wonder if-
approaches.
Yeah, maybe they meant quarterly payments. too.
Yeah. Oh, okay. So one thing I was going to say is payroll taxes. Those do have a quarterly filing, but that would be like if you have an employee
Mhm.
where you're filing W-2s. If you're an S corporation, even if you're the only employee, you might have a quarterly tax filing requirement. But to your point, it's likely about tax payments. So when you are paid as an independent contractor, paid on a 1099, it does not have typically any kind of withholding for taxes. So when you're a W-2 employee, your salary, you get paid your salary, but then your employer withholds federal and state income taxes, as well as FICA, Social Security, and Medicare tax. And they actually send those taxes to the IRS or to Illinois for you. When you get paid on a 1099, that withholding doesn't exist. So not only are you not withholding federal or state income taxes, but you're also not making any kind of payments towards your ultimate probable self-employment taxes. So there are requirements from the IRS's perspective that says, basically, they don't want us all to make a bunch of money throughout the year and then only pay them at the end of the year. They would like to get their money throughout the year, like they do from W-2 employees. So to that end, they have what is called, quarterly estimated tax payments. And I say IRS, but it's the same for the state of Illinois and many other states as well. So you do have a requirement if you're going to owe a certain amount of money at the end of the year, that rather than waiting till the end of the year to pay that liability, you're supposed to be paying towards it on a quarterly basis. I won't bore you with the exact technical details of, okay, this much tax based on your prior year tax, but there are some specific limitations and how you can kind of figure that out. Generally speaking, if you made $20,000 during a quarter and you know that your effective tax rate is 20%, and then you also know that your self-employment tax is like 15.3%, add those together, multiply it by your net profits of 20,000, write a check for that amount.
Right.
Now that's an extremely simplified example, but that's essentially what the nature of it is. So those are requirements if you are going to have a certain amount of liability at the end of the year. The downside of not paying those payments is that the IRS could subject you to what they call an underpayment of estimated taxes penalty. So basically they say, well, you made that 20,000 and, say you should have owed us, I don't know, maybe we'll go with $5,000 as a quarterly payment, but you didn't pay it. So instead, at the end of the year, you have a balance due that includes that amount. So they're going to say, well, you should have paid it to us throughout the year. You didn't pay it until a year later. So we're going to hit you with a penalty on that 5,000 for the kind of like the lateness factor of it. So
And it's not cheap either, right? It's a pretty
Yeah.
significant percentage.
yeah, I mean, typically it's not terrible, but it is driven by the tax. So if your estimated payment is $300, your estimated tax penalty might not be too bad.
Right.
Now, if your estimated payment is 300,000 or 3 million, like we're certainly getting into larger numbers here. So, and again, like I mentioned earlier, there are some very specific calculations where in order to determine what your actual quarterly liability is, you have to look at not only your current year tax, but you can also look at your prior year tax. And there's an analysis between the two that allows us to establish a safe harbor, which would allow you to make lower payments possibly. So it's very important to look at kind of the whole picture, and then make an informed decision about whether that penalty is an acceptable, I guess, cost to you for the,
Right.
cash flow to not have your taxes paid
Yeah,
throughout
might
the
be
year.
an advantage to keeping that in your pocket.
There's definitely a school of thought that,
That's a good point.
yeah.
So I have another one here. In a few years, could I change my business type? We started out, it sounds like a sole proprietor, that would be easy to change from
Yes.
because you haven't done anything yet.
Right.
So,
Right. Yeah. I mean, that's spot on. If you start from, an easier or more flexible entity type setup, then it's fairly simple to kind of build on that. If you start as a C corporation and you suddenly to say, I want to be a sole proprietor, that's not going to be as easy.
Yeah.
So I typically say, if in doubt, start on the easy side of things rather than just kind of jumping into the deep end and setting up that C corp or getting a multi-member partnership going when you're not really sure what you want to do. Maybe start as a sole proprietor and then kind of figure things out, because it's certainly easier to build on that, both from a tax perspective, legal perspective, registration perspective, than it is to try and kind of pull it back, untangle it. Exactly. And a lot of times there can be unintended consequences once you do get it set up. And then that untangling can be a lot more painful.
I think we've covered a lot of these. We have some folks, anything that we missed here that popped into your brains while you were out there with a live studio audience? So
Live studio
how we'd
audience.
reach out.
I like it.
Anything that, questions? Yep, I will.
What relating to property do you holy cow, I should have done something.
Okay, so in,
Partner with the find a good accountant. Very front end, most people are saying, I don't want to spend the money. The turbo tax, but what are some things that you recommend?
Right. That's a great question. Like I said, a few minutes ago, like kind of once you get the ball down the line, it's a lot harder and more painful to untangle something than it is to build it, correctly from the get-go. And so I do think that that's something that we see a lot of people that are just starting out. It's a mistake that's common is, for whatever reason, whether it's, administratively, it's expensive, they look at it as it's expensive or unnecessary to retain an attorney or an accountant. There are definitely benefits to having those people in place. They can, be basically kind of your hub of your business to help make sure that you've got all the things in place that you need in order to be successful. And so, of course, as a CPA, I would certainly advocate for having a tax professional that, kind of knows what they're doing. But I think that's really important is for anyone that's starting out, especially if they're going to be like an independent contractor, 1099, where there's not any taxes being paid on their behalf throughout the year. It's very important to get a handle on that early on, because unfortunately, if you wait until tax time next year, and in the meantime, you don't pay any taxes on that, you make 100,000 and you don't pay taxes on it, it's going to be pretty painful when it gets to April and, you owe $30,000 or whatever.
Probably
So
just if you divided that 100,000 by a quarter, coming and
Right.
seeing you and learning to pay quarterly
Right.
would have saved them whatever the first quarter penalty would be. I mean,
Right, absolutely. Yeah, so I think looking at it from the perspective, it is a service certainly, and we do have, a deliverable, a commodity, we file a tax return, but at the same time, to me, the value that a professional CPA firm or, an attorney or even a good insurance person, those people are providing value by helping you with your business because they have the benefit of the experience that you don't have, So I always talk to clients about, maybe I have a person that owns a restaurant. The bottom line is that I would be terrible at owning a restaurant. I would just eat all of my food and it wouldn't probably be very good in the first place, but I'm a really good accountant. You know what I mean? And on the flip side, that restaurant owner is going to make some fantastic dishes, but maybe they're just not very good at numbers.
Right.
And so I think acknowledging that in the beginning, and first of all, educating yourself, seeking a professional and having a conversation about, here's what I've got going on. What can you tell me? What are some pitfalls? What are some things I should be thinking about? And then once you've got a little bit of education and knowledge and awareness under your belt, you can make the decision about, do I want to get a full service CPA that's going to do all of my bookkeeping and my, all of my accounting work? Or maybe am I someone that can kind of do a mixed bag? Maybe I'll consult with them and have somebody kind of to answer some questions, but I'll enter my own information into QuickBooks or whatever, so there's a lot of different levels of advice and service that we can provide.
Okay.
But I think it's really just getting in that room and having that conversation, because you don't know what you don't know.
Right.
And there's nothing worse from our perspective, when somebody comes to us after the fact, oh my gosh, I owe all this money. How can I fix it? And I'm like, oh, you kind of can't fix it. You just need to pay it, So certainly knowing that up front. And honestly, there's a lot of things that we can do to plan for those sorts of things. One of the things that we think is really important with our clients is doing tax planning throughout the year. So we focus on that pretty heavily in like the November, December months. And the idea of that is that, you may have had a year where you've made a lot of money. The housing market's been going great and it's just been a great year. And so maybe we have some ideas or some thoughts about expenses you can push into one year that might minimize your tax liability. And, there's a lot of tax opportunities out there, and not that, it doesn't exist. You can't go and read the IRS publication yourself, but sometimes it's hard to find. And honestly,
I can't.
they're not that exciting. So I wouldn't really recommend it. But I guess the point I'm trying to make here is that oftentimes I see individuals shy away. They say, oh, this much money for my tax return and this much money to calculate my quarterlies. Well, honestly, working with a professional might end up saving you that money by finding some of these tax opportunities. One in particular over the last several years that I've seen time and time again that people miss is what's called the qualified business income deduction. So this is a 20% deduction that came about from President Trump's Tax Cuts and Jobs Act a couple of years back. And generally speaking, it's a 20% deduction that you can take against your business income. It's something that's calculated at the personal level. And I can't tell you how many times I get returns, whether they're self-prepared or sometimes, from other, H&R Block, or I don't mean to call it H&R Block specifically, but a different tax firm can even make a mistake or an error, or just maybe they missed it. They just didn't realize what it was. And so that's just one example that I can think of that can have a significant impact where, if it's $100,000 in net income and you've got this 20% deduction that you have as an opportunity, but you don't know about it, that's $20,000, so definitely can be some tax savings to be considered. And I think in the end, generally from a tax savings perspective, as well as just a stress and anxiety, it can often pay for itself.
Yeah,
So
there's some value there
yeah,
too,
a
right?
little value there.
When you read the wealth building books too, they almost all to a T say, find a professional tax person, find a great attorney, find a great realtor, right? To help you choose the right properties. So you're just part of the
Absolutely.
team, and it's worth it. So good question. Good question.
Last question, how diligent does a realtor need to be in fractional sense?
Good question.
At what level of finding?
Okay.
Does that track?
Yeah, I mean, generally speaking, the requirement from an IRS perspective, if a return was examined, if it was audited and you're sitting in a room and having to prove out those numbers, you typically do need to have some kind of documentation for any business expenses that you have. So from a general perspective, I would say pretty diligent is probably the safest route, because if you were examined and the agent asked you to produce a receipt for XYZ and you were unable to, that agent would have the opportunity to just entirely disallow the deduction. Now, is a reasonable agent necessarily going to do that if you can't produce that one Office Max receipt? Like, probably not. But I think it's something that's really important to get into a good habit. There's so many automations and features and functionality and apps on our phones,
what I was gonna
QuickBooks
ask you.
Online. It's out there. And again, it's very, very much what I said earlier. Like, if you start out strong in the beginning and it becomes a habit, then it's just like kind of easy. It's second nature. So I would say as diligent as possible. Certainly for any types of, meals expenses, that's something that I see a lot of times people might get a little bit lax on. If you're deducting a meals expense, It needs to be, ordinary, necessary in the IRS's perspective. You need to have a business purpose of what the meeting is for. And so I think it's a best practice, when you go out to eat and you talk about, the next property you're going to list or whatever the case may be, it's important, maybe just jot down on that receipt or find one of those apps where you can just note, this is where I went, this is why I went there, this is who I was with, and this is, kind of what the idea was. And honestly, just having that stuff in your file is going to make any future examination a lot easier and less stressful in general. I also think from a managerial perspective, I talk a lot about taxes, of course, but it's important to know where your money is going, to kind of keep an eye on how am I running my business? And, are there areas where I could adjust my costs, or are there maybe areas where I want to spend a little bit more? Hey, I was really light on marketing this year. Like maybe if I dig in there, I can generate some additional revenues next year, something like that. So I think people tend to talk about record keeping from a dull IRS perspective, but it's really important too, I think, be a productive, efficient business and, be as profitable as you can be. That's the goal, right?
That's a great.
So, yeah.
That's a great point. You said apps, and I'm using one. How do I need still all the receipts and a picture of, and is having a notation in an app for a meal or what have you, is that gonna task muster most of the time? And maybe that's a hard question.
A little hard question. There's always a little bit of kind of, there's the letter of the law, the spirit of the law, black and white, shades of gray, blah, blah, blah. So, if I speak to you in terms of the actual specific rules, no, you need the receipt.
Okay.
You need the receipt. You might even need the bank statement for the receipt, they can get pretty specific. Now, again, to my point earlier, if you have a reasonable agent and it's clear that you've been making a good faith effort, I certainly can't make any promises and nor would I, but generally, as long as you have been doing your best to, behave in such a manner that shows you're keeping good records, you'll probably be okay. Having said that, if it were my business, I would keep every receipt. I would retain it for, at least 7 years. It's probably kind of obnoxious. Maybe I would choose to do electronic files instead of having boxes stacked up in my garage, but certainly would have something. And again, if you can just get it nice and neat today, that way you're not having to scrounge through old paperwork and go through that hassle of, I changed banks and now I can't get my bank statements from 4 years ago. So definitely doing it from day one the right way is very helpful.
I doubt this has happened to anyone else in this room, but you pay for gas at the pump and you ask for a receipt and it tells you receipt is inside with the cashier. Do I have to run in there and get that receipt from that cashier?
I think in that case, most likely having the record, it's gas, like you're getting gas. It's pretty obvious that you got gas. So I think as long as you've got the bank statement or the credit card statement that shows it, you're probably fine. Now, if they look at your bank statements and you're spending $400 at Citgo every 2 days, they might go, "Oh, you're a realtor. Like you're not filling up a semi. What's going on here?" But assuming it's pretty, yeah, right, right, yeah. It's my insurance
You've been
plan.
following me around, haven't you? Good answer. Well, anything that we've missed?
7 years, generally speaking, yeah, that's
Retain
a
records
good
for
number for records. Some might say it's a little overboard, in certain situations like fraud or something, they theoretically could go back further, but generally speaking, yeah, I think 7 years is a good target.
Well, you've been awesome, Bethany.
Either one.
I had Bethany in my head and I said, awesome.
No
You've
problem.
been awesome, Bethany.
Thank you.
Apex CPA and consulting.
Yep, Apex
How do
CPAs
people
and
find you?
Consultants. Well, we're on Google, we
Okay.
can certainly Google us. We are local here in St. Charles. We also have an office in Phoenix, Arizona. So if you're in Phoenix and you need a tax accountant, we're there as well.
Cut that off if we go there to.
But yeah, our website is, apexcpas.com, pretty basic. So feel free to visit the website, reach out to me. I'll leave some cards if you'd like to kind of send them around, and happy to help if we can.
Thanks so much. Appreciate it.
Absolutely.
High five.
Great. Thanks for having
Thanks for
me.
coming to
Thank
the
you very
live
much.
reel at the Mexican restaurant. See y'all.
Thanks.
Right, like that arrow was right on top of my forehead.